All right, well, let's go ahead and jump back into our discussion of the fulfillment process. I'm hopeful that we will be able to wrap this up in our time together today so as to start into something new next week. We are in the process of talking through the steps in the fulfillment process. The two big things that I would encourage you to focus on in your studies here as you think about pending exams and things of that sort is with each of the processes that we have talked about and certainly this process. Um, Make sure that you're familiar with the documents, which documents go with which process steps, and in general, the content of those documents, and along with that, the purpose of the document. I'm certainly never going to, on an exam, ask you a question like, tell me all of the things that are contained in a goods receipt document. But you might see a question that would say, which of the following can be found on a goods receipt document? And my hope is that if you know the purpose of the document and in general you know the content, it should be pretty easy for you to decide what goes there and what does not go there. So documents are a key element. And then as we talked about last time, accounting transactions, not only what the accounting transactions are in terms of debits versus credits, but where they occur, which process step and which process triggers which particular set of postings. And I really do think that if you know those things, you are positioning yourself to do very well on the exam and really to understand some of the key things that this course is focused on. So talking about the fulfillment process, last time we talked about the pre-sales activities facet of the fulfillment process, and we talked about the role of CRM, both CRM Lite, which you can find in a traditional ERP system, and then we talked a little bit about further functionality that might be delivered by a CRM system. So we talked about receiving a purchase order from a customer, putting that into our system and as a sales order document. And then where we left off last time was on the shipping process itself and talking about some of the facets of shipping and why shipping is so important to us. And we left off with the observation that shipping slash goods issue, we tend to think of those things together, is the first step in the sales order process with a financial accounting impact. And we'll talk about what that is here in just a moment. That's a key fact for us to know about this. So when we are shipping an item out, one of the things that we will put with that is a delivery document. And the delivery document travels with the materials, and you can see the basic things that are here. It has quantities and dates related to the shipment. It has a description of the material, its weights, its unit of measure. It obviously has information about the customer because this delivery is headed to a particular destination. It has a good set of organizational data, and this is an example of what I was talking about before with organizational data. If you know the purpose of the document, then it's pretty easy to figure out what should be here. Obviously, delivery plant and shipping point makes sense. Company code, because there's going to be a financial accounting implication, as we just observed. Sales area, because this is a sales-related document. So all of these things are what make up a delivery document. And so the structure of a delivery document is pretty straightforward. The header section is going to have the dates and where the items are headed. And this is a two-level document. So we have a header and we have line items. And the line items are simply listing the materials and the quantities. So keep in mind, one sales order document could result in multiple delivery documents being generated. Why do we know, based on things that we've already discussed, why do we know that it may be possible for one sales order document to result in multiple delivery documents? What is that illustrative of that we talked about last time? Um, but that would not be the same, I don't think that would be the same sales order. So what did we observe is unique about the sales order document? Yeah, sales order document is a three-tiered document, if you will, where it has a header section, it has line items, and then those line items have schedule lines. So if you think about it, if we said that we're going to deliver some things on June 1st and other things on July 1st, that obviously means that those are going to have to go onto different delivery documents. And so the delivery document is a two-level document, and it relates to each of the shipments that go out to a customer. And in fact, that's what this next slide is about. We can have one order that can be broken up into multiple deliveries. That's pretty straightforward, and as we just observed, this will be very, very common if our schedule lines indicate multiple shipping dates or other things of that sort. We can also see a situation, though, where multiple orders can be consolidated into one delivery. So the scenario here is you might have a company that actually places multiple orders with you, maybe from different salespeople, maybe the orders come in even on different days, but the system will look at them to see if they can be consolidated into a single delivery. And the key element here is that the system is going to look at four different things, most of which are obvious, but perhaps not all. It has to be the same customer. I mean, that's kind of obvious. We can't say, oh, let's take these orders and let's put them together into one delivery and they're different customers. That's just really not going to make sense at all. So the system will look at, okay, do we have any deliveries or any shipments going out that are going to the same customer that are coming from or originating from the same shipping point? So if they're both shipping out of Dallas, okay, that's good. So we have the same customer, we have both of them going out of the Dallas plant. They're going to be delivered on the same day. It's not like one's going in June, one's going in July. We can't consolidate those. But if it's the same customer, same shipping point, same delivery date, and then lastly, the same ship to address. Realize that you could have a customer that has multiple ship to addresses, and so we've got to check not only that it's the same customer, but that it's going the same place. And so if all of these things are in fact the same, the system will endeavor to consolidate multiple sales orders into one delivery. I used the Amazon as an example of several things when we were last together. This does not happen with great frequency, but I have had on a couple of occasions before situations where I've placed two orders with Amazon on the same day, but they were hours apart. So they went into the system as two distinct orders, but they were consolidated into one box for delivery. So Amazon makes an effort to do this just like other companies would. The idea here is pretty straightforward as to why we would do this. This is going to save us time, save us money, be more efficient than replicating work that could be done just at one time. All right, so very, very important next slide here. The impact of post-goods issue. Well, first of all, what is post-goods issue? Let's start with that. Post-goods issue is when we formally relinquish ownership. So remember we talked previously about our Incoterms, FOB shipping point, FOB destination, and all of those different things that specify what time horizon is going to be used for that. Well, when that particular point in time arises, the way we memorialize it, the way we account for that is we run a transaction called post-goods issue. You've actually done this in your lab work. You set about to do the fulfillment process, you picked materials, you packed materials, you created a delivery document, and then the transaction that you go in and you change a delivery document, and there's just a button at the top center of the screen that says post-goods issue. You click that button and you're done. And what happens then isn't much from a user input perspective, but some really, really important things happen. A material document is going to be created that is going to do a number of things for us. But what's the big thing that this material document is going to keep track of for us? What do material documents often keep track of? Okay, correct. What about materials to follow up on that? What's that? Close, but no. You're on the right pathway, but you took the wrong turn. Inventory level, okay? To go to what was said along with that, we're going to see two documents created here. We're going to see a material document created, and we're going to see an accounting document created. The material document is going to signify that we now have, let's say, 35 fewer, whatever it is. So when we hit the goods issue button, when we post the goods issue, a material document is going to be created that takes care of the quantity and letting the system know, hey, we now have fewer. An accounting document is going to be created that fundamentally is also going to be telling the system we have fewer, but its focus is not going to be on quantity. Its focus is actually on the money side of this. So if this was a material that we tracked as an asset, if this was a stock material that has an asset account associated with it, then that particular account is going to be credited, indicating that we have less of a particular asset. But the other side of that is cost of goods sold is going to be debited. And I will show you this with some T accounts and otherwise here in just a moment. So the financial accounting associated with posting goods issue, we said that shipping or issuing goods was the first step in the fulfillment process with a financial accounting implication. Well, that's what it is right there. If it's a stock account, that account is going to be credited to indicate we have less inventory, and the offsetting debit is going to be the costs of goods sold. So we have a material document created, we have an accounting document created, we haven't talked much about the cost accounting document, but the cost accounting document is going to be created to capture the cost of goods sold data for us to use that in profitability analysis if that is something that we do in our organization. And then we have two other things that are going to happen here. A billing due list is going to be updated because we're going to have to invoice the customer, and the sales document is going to be updated to reflect we shipped out this particular order on such and such a date. Now I'm going to suggest to you that at least 4 of these are really, really obvious. And so once again, great test question. At post goods issue, what documents are created? And it's really, really logical. We need to tell the system that we have fewer of that item. That's going to be done with a material document. We need to take care of the financial accounting implication of that. Okay? We're going to use an accounting document for that. We need to tell the system to bill the customer. Okay? That's another document. And then, oh yeah, we shipped this out because we had a sales order document that told us to. We should update that sales order document to let it know that we have in fact shipped this out. So the only one that you might have to kind of specially remember is the CO document, but the other 4 I think are just very, very logical. And if you'll think about documents in that sense, I think it will be very, very easy for you to keep track of all of this. Now, the one thing that I haven't addressed, at least at this point, is what happens here if this is not a stock material. What if this is a consumable material, and so we weren't tracking it as an asset? And the answer to that will come in a couple of slides here. But this list here assumes that we are talking about a stock material, which quite frankly is what we're going to see the vast majority of the time, because we don't really sell consumable materials. We sell stock materials. So let's look at what we just talked about here in the context of T accounts. So customer places an order with us. And in fact, the order was for inventory of finished goods. They ordered some finished goods, and they ordered some trading goods. And so we gather up those materials, and we ship them out to the customer. And so we credit the corresponding asset accounts for what we just shipped out, and we debit costs of goods sold. Now, there is something of critical importance for you to realize here that is very, very subtle. Question: how much does the customer owe us at this point? Okay, because I haven't billed them. But hypothetically, how much? What will they eventually owe us? Okay, I asked you a question that we don't know the answer to. What is very important to realize is this is not saying that the customer owes us $43,500. Unless we are running our business very badly, they owe us a lot more than that, okay? This is based on our cost of the materials. So the customer might have sent us a PO, and the PO might be for $100,000. But that doesn't mean our cost of those materials was $100,000, because we want to make a profit off of this. So it's critical to realize that these numbers here, that I'm crediting these accounts, this is based on my valuation of those materials inside of my company. And so the credit here is based on the value of those materials. And so the offsetting debit to cost of goods sold is based on the value of those materials. So what we can't let happen here is we can't let our cost get confused with the price that we're charging customers. This is totally based on our cost for these materials. So when I ship things out, that is when I realize cost of goods sold, okay? So that's the financial accounting implication of the shipping step. Now, for those of you that have taken an accounting class, this should be really straightforward, but just a bit of a review here. For those of you that perhaps it's been a while since you've taken an accounting class, or you haven't taken an accounting class, the fundamental equation which drives our company income statement is represented here. We have sales revenue, which is what we're actually charging the customer. So hypothetically, I just sold the customer $100,000. You know, they sent me a PO for $100,000. Well, that's not all profit. From that, I have to look at, okay, what was my cost of what I just sold this customer? And let's assume that we're talking about the same transaction as a moment ago. So my cost was $43,500. Well, when I do the math on that, my sales revenue less the cost of goods sold is my gross profit. So at this point, my gross profit here is $56,500. Overhead is all of my other company costs that are not costs of goods sold related. Keep in mind that although I'm illustrating this with a single sales order, this really is something that we look at cumulatively for for all sales orders, all costs of goods sold, whatever have you. Let's just assume in this situation that we are talking about cumulative sales at this point, and my overhead as a company right now is $15,000. So my gross profit less my overhead gives me here my net profit, which I think is $41,500 here, which is what we typically, think of as the company's profitability. There is one other thing that we have to account for, as you see here, which is we are likely going to have to pay tax on our profit. And so that being the case, we would have to make a deduction for those taxes. And then what we are left with is net profit after taxes. So what we just saw happening in the process step that we discussed was we just captured this number. When we shipped the order out to the customer, we have now captured the cost of goods sold. Questions about that? Now, once I ship out an order to the customer, there is something that I want to have happen as quickly as possible. Matter of fact, if I could do these two things simultaneously, that could be great. But if I can't do it simultaneously, I want there to be as short a period of time between shipping out the order and what happens next. And what happens next is billing the customer. If I ship something out at 8:15 in the morning, it would be great if the bill could be on the way to the customer by 8:20. And so when we talk about billing, what we're talking about here is creating an invoice that's going to go to a customer. Now, just like we observed that multiple sales orders could be consolidated into one shipment, we could have multiple shipments get consolidated into one billing document. This is a little bit more challenging because there's the potential here for this to introduce confusion. And I have worked with, both as a customer and as a vendor, many organizations that they do this. They consolidate shipments onto a single invoice. And there's a real potential there for customers to get a bill and have it be very confusing to them. So how are we going to consolidate these? If we see that we have multiple deliveries, that's the same payer, the same billing date, and the same destination country, then we can consolidate that into a single billing document. The other thing that can happen is we could actually have one delivery that gets expanded into multiple billing documents. Now, why in the world would we see something like that? Well, the fact is there will be times when a customer will place an order with us and they will say, we want to order X, but we need you to split bill us. Let me give you two scenarios. Many organizations will buy something that consists of both a good and a service. I buy, let's say, a new projection system for my company to have in our conference room. And I also, along with that, purchase installation. Well, because of the way I account for things, I want to be billed separately for the equipment versus the installation. Now, you're going to have to put your thinking caps on here. Why would I want to be billed differently for the equipment versus the installation? The equipment I'm going to treat like an asset and I'm going to depreciate it. But the installation, I'm going to expense it right away. So I might want to request two different bills, one reflecting the value of the asset, and then put the installation on a whole separate bill. I might also, and we see this happen here at the university, where depending upon who I am ordering things for, sometimes I pay for it with what we call state money, and sometimes I pay with it from money that has come from contributions to the university. We call that foundation money. So I might place an order with a vendor and say, I'm ordering 250 units. Can you send me a bill, though, for 200 of them and then 50 of them? Split my order into two different bills. So there will be times that the customer might request for you to split a delivery into multiple bills. And we can do that. Consolidating of bills, this would happen automatically. Unless, of course, my customers told me they don't want us consolidating bills. And we could have that information in our customer master record or even in a customer material information record as it relates to certain materials. So the key thing here is, as long as it's the same payer, the same billing date, the same destination country, we can consolidate this. The reason why this gets kind of potentially confusing, and we'll see this when it comes to processing customer payments. You know, let's assume here's me and here's customer A. And customer A last week placed 5 different orders. And this one was for 2,000, and this one was for 3,000, and this one was for 5,000, and this one was for 8,000, and this one was for 5,000. Okay? And it just so happens that I shipped out this one and this one on the same day. So same payer, same billing date, same destination country. I could consolidate those into one invoice for $10,000. Well, do you see where when the customer gets that, they might be confused as to whether or not that's the bill for order 1 and 4, or order 3 and 5, or order 1, 2, and 3? I mean, what we've got to be careful about here is that our bills are clear enough that the customer can accurately reconcile things on their side to know that we have done this consolidation. So a lot of companies won't consolidate bills. Even if they consolidate shipments, they'll still bill this out as 5 separate bills just for the sake of not confusing the customer, because a confused customer tends to delay paying. So there can be reasons why we would not want to do this consolidation. So we send the customer a bill. Pretty straightforward what's going to happen here. We're going to generate an invoice. A lot of times we'll do this with a program that we just run that goes out and looks at all of the bills that are due, generates those, sends those out to the customer based on how our system tells us to communicate with the customer. But then what will sometimes happen is we send the customer a bill, and there is a reason why we need to adjust the bill. So there are 2 different ways we could adjust the bill. We might discover that we billed the customer too much, or we might discover we billed the customer too little. The way we handle that is, if we sent the customer a bill that was too high, maybe we charged them a price that was too high, presumably inadvertently. Maybe we sent them some products and some of them were defective, and so they're going to send them back to us. We don't want them to pay for them. Or just in general, there may be some other reason we wish to reduce the amount the customer has to pay. We do that with a credit memo. Now, I've had this happen recently before, where Amazon ships me something that's broken. And on one occasion recently, I contacted them and said, this item is broken, and they said, we'll ship you out a replacement, and you know, we don't want the broken one back. Just throw it away or do whatever you want to with it. I bought a book a couple years ago, and when the book came, it wasn't what I thought it was going to be at all, and I contacted Amazon and said, I want to return this book. And they were like, just keep it and we'll credit you back the money. Okay? So sometimes we might do something like that, or the customer might actually be returning something to us, or it could be something where we bill the customer at a price the customer contacted us and expressed dissatisfaction, so we agree to kind of cut the price to make them a little bit happier. Essentially, anytime I need to reduce the amount of a bill, I do that with a credit memo. Usually customers are really happy about credit memos, but we do sometimes see a situation where we need to fix a billing error, and it means the customer is going to have to pay us more. Maybe we discover that we invoiced the customer at too low a price. Maybe we gave the customer for some kind of discount that we realized they really did not qualify for. So anytime we need to increase the amount the customer owes us, we do that with a debit memo. From the customer's perspective, debit memos aren't as positive as credit memos, obviously. So one of these represents a decrease to the amount the customer owes us. The other represents an increase. So when we talk about billing documents, notice that there are, in fact, 3 different kinds of billing documents. We have invoices, which we're going to see a lot of, and then we have credit memos and debit memos, which are going to be far less frequent. So we said, yes, ma'am?
Did you give an example of when a debit memo would occur? Would that be like when the invoice was different than the quote?
Yeah, usually it's going to be, we discover an error. We should have billed the customer $5 a unit, and we accidentally billed them $4 a unit. And while the customer might not be thrilled, they certainly understand it was a mistake, and that's fair. The other thing could be, just being hypothetical here, we invoice them for $5 a unit because they bought 1,000 units and that qualified them for a discount, but then they decided they wanted to return some of them to us, which meant they no longer qualified for that discount. So we're going to have to raise the price. So anytime we need to communicate with the customer that they have to send us more, the debit memo is how we do that. Yes?
Could that not be tricky with the legally binding with the purchase order?
It could be. You know, there's an element of which the purchase order is legally binding, but in actual business practices, you treat it with a little bit of flexibility. You know, if somebody sends me a purchase order for 10,000 units, that's a legally binding obligation if I accept it. But most businesses, if the customer were to call them up shortly after receiving the PO and say, hey, we made a mistake. I know our PO says 10,000. Can you void that and just ship us 8,000? The business would be legally entitled to say, no, you ordered 10, we're shipping you 10, take it. But they realize if they do that, the customer may never order from them again. So they're going to treat it with that kind of flexibility. Now, if they've already shipped out the 10,000 units, sometimes they might have to say to the customer, we've already shipped it out, sorry. But, you know, this gives us a way to kind of account for those exceptional circumstances. And, you know, like I'm saying, in a typical organization, we may issue thousands of invoices a day and, you know, 10 of these a week. Other questions? Okay, so what goes in the billing document / invoice? Well, we obviously are going to have organizational data here. No surprise what the organizational data is going to capture for us. It's going to tell us, okay, the company code, because that's going to capture the financial accounting implication. And then the sales area, that tells us what distribution channel, what division, so on, what sales organization gets credit for this particular sale. The bill is going to have information. These are the materials. These are the quantities. This is the date it was shipped out to you. Obviously, it's going to have the customer information on it because the post office kind of requires an address when we deliver a bill to a customer. So you're going to have the name of the company and other things of that sort. And then an itemization here of quantities, the customer PO number, other things like that all going to go into this invoice. So the bill itself is a pretty straightforward document. It's a 2-level document. You know, the header is going to have the basic information about the company, their address, and things like that. And then the line items are just going to list the materials that they owe us for. And so that is the billing document. So we said that when we ship out the materials, that's when we capture cost of goods sold. When we bill the customer, this is when we realize the revenue. Okay? So that's why, you know, from a salesperson's perspective, let's pretend we're salespeople and we get paid on commission. That typically means that our commission will be calculated when the revenue is booked. And I might get 2% of every order that I sell. Well, in that case, I want the customer to be billed as soon as possible because that's when we realize the revenue. So I might make the sale on Monday. We don't ship it out till Tuesday of the following week, and then we bill the customer Thursday of that week. You know, there's a 10-day lag between, in my mind, when I made the sale and when the revenue is actually realized by my company. So when we send out the bill, when we invoice the customer, that's when we realize revenue. So the billing step will create an FI document. And what that document is going to do is it's going to update a customer account to reflect that that customer now owes us money. And then the offsetting credit is going to be to revenue. And I'll show you that with T accounts here in just a moment. There will be a CO document created here as well, because we said before we capture costs of goods sold for the sake of doing profitability analysis. The other side of that is the revenue side of that. So there's going to be a CO document here that captures that revenue. And once again, fairly logically, we're going to go back and update the original sales order document to reflect, you know, we made the sale on such and such a date, we ship this out on such and such a date, and we billed the customer on such and such a date. And we'll see how this all comes together in what's called the document flow here in a few minutes. What we're observing here is why, if you've ever worked at a company before that is concerned about profitability, and you get close to the end of either the fiscal year is when you see this a lot, or even intermediary fiscal reporting periods. You know, if our fiscal year ends on June 30th of any given year, usually we make a really big push to make a lot of sales, you know, late in the month of June. But the key is we can't just make those sales. In order for it to count as revenue, we've got to actually ship the materials and bill the customers. And so in a lot of organizations, when you get close to the end of the fiscal year, it gets pretty frantic because it's not good enough just to get the order from the customer. If you want to realize it in your financial accounting processes, you've got to ship the materials out and bill the customer as well. And I have known some companies in the past that when they get close to the end of their fiscal year, things get really, really sloppy because the warehouse is just focused on get this stuff out of here as quick as you possibly can. And so you see stuff that's not properly packaged. You see stuff that's, you know, thrown into boxes or otherwise just because they know they want to get it out the door for the sake of making the current fiscal year look better from an accounting perspective. So when we bill the customer, everything that's up here with a 1 next to it is what we did before when we ship the item out. So notice the big thing here now. We said that everything that has a 1 by it was done based on our costs. Well, everything that has a 2 by it is based on our selling price. So in this case, we can now answer the question I asked you before. How much did we charge the customer? We charged them $86,700. And so you will notice that we debit the customer account, indicating that they owe us $86,700. This is a receivable account. Receivable accounts are assets. I indicate the increase in the value of an asset by debiting the account. So that's why this is a debit to Rocky Mountain Bikes in this example. That results in an automatic posting to my accounts receivable ledger account in the general ledger, and then the corresponding credit to revenue that you see for the $86,700. Now, I said before that if I took my revenue and I subtracted my cost of goods sold, that's going to be my gross profit. Where's my gross profit account? It's not one, okay? You figure out your gross profit by looking at the balances of these two accounts and doing the math on them, okay? So that's going to be something that would be handled in a closing type transaction, but there's not actually a general ledger account associated with that. Questions about this? Well, everything up here is based on, for trading goods, for example. I don't know what these were. Let's say they were bicycle helmets. We bought them. We paid $1,500 for them. So when we sell them, we're basically, this is just reflecting that when we bought it, we debited this asset account $1,500, and now all our bicycle helmets are gone. So to get us back to zero, we credit it based on what we paid for it. Here, for my inventory finished goods, I had a debit sitting out on this account equivalent to $42,000 that reflected how much I had invested in making those items. If that was all I had in inventory, just to make this simple, I now have nothing. If before I had $42,000 there, the way I get rid of it is by crediting the $42,000. So this is just totally focused on the value of it based on my internal calculations.
But putting it in the inventory account, when you put it market price, not your cost to produce it, because it's an asset.
There's a couple different facets to your question. I would not value it based on what I would sell it for. But the fact that the value of what I own, considered at cost, might change is a very valid scenario. For example, let's assume that I make these bicycles, and at the time I make a bicycle, it costs me $100 to make that bicycle. And so I made however many, what would that be? I made 420 bicycles. And so I would have had the debit out there for $42,000 corresponding with that. Well, maybe over time, my cost of making a bicycle goes up, and now really it's costing me $110 to make a bicycle, which by extension means that the bicycles that I made previously have a higher value associated with it. There are calculations that we can do that would be reflective of that. If you've ever taken a accounting course, you talk about things like LIFO and FIFO for different ways of valuing inventory. We're not getting into that degree of detail here, but there can be that kind of fluctuation that may cause us to need to go in from time to time to make adjustments to the balances of certain accounts. But we're still always going to value these things at our cost. Okay. Good question. Other questions? All right. Now is the favorite part of the process, which is customer pays us. So our job here is to post their payment. What's going to happen here is we're going to create an FI document. And of course, that FI document is going to update the general ledger. And pretty straightforward what's going to happen here. We're going to be debiting some kind of bank-related account, most likely a cash account, to reflect that we now have more money. And we're going to be crediting the customer account, which reflects that they now owe us less money than they did before. And then there's going to be an update, happens automatically, to the accounts receivable account by way of automatic posting. Payment is one of those things that seems like it should be really straightforward and can be really straightforward, but it can also carry with it a number of kind of challenges. I don't know if you've ever done anything like this, but a lot of times college students, just as one example, often don't have an abundance of money. And so hypothetically, you get a bill from, I don't know who, the electric company, if you pay your electric bill yourself, and you get a bill in, we'll say April, for $75. And you don't have any money, so you don't pay it. In May, you get a bill for $85 more, but you still owe the $75 bill, and you still don't have any money, so you still don't pay it. Well, in June, you get another bill for $95. I guess you're running your air conditioner even more. And now they're telling you, if you don't pay us, we will turn off your electricity. So that gets your attention because you don't want to go without electricity, and so you send them a check. Now, of course, the way this should have played out was in April you should have sent them a check for $75, and in May you should have sent them a check for $85, and in June you should have sent them a check for $95, but you didn't. So now, at the end of June, you send them a check for, you do kind of this internal math. How much do I have to pay them so that they might still not be happy with me, but they won't turn off my electricity? And you say, all right, if I send them a check for $50, that'll probably buy me a little bit more time, okay? Now, I don't know if any of you have ever done anything like that. You don't have to raise your hands if you have, but it's not that unusual a problem or that unusual a scenario for people that are short on funds, and it happens sometimes in a business setting too. So sometimes really bizarre things happen, like you bill a customer for a certain amount, and then a check comes in and they don't match up. And we've got to figure out, okay, you know, how are we going to handle that situation? So the payment step, we get an incoming payment. And of course, there are going to be people in our organization that are tasked with actually keying this into the system. And the big thing here is applying those payments to open items. See, here's the thing. Let me go back to my scenario here. Maybe every time you're late, they're going to charge you a penalty of 5% a month, okay? And then let's just say hypothetically, after you're 90 days late, there's going to be a 10% penalty, okay? Well, when they get that check for $50, where are they going to apply it? Given the set of rules I just outlined, it is quite possible that they will apply it against your June payment, so that your April and May payment continue to generate the most in late fees for them. But different organizations will have different rules and different policies as to how they actually allocate customer payments against accounts when it's not a very directed payment. If you've ever owed a credit card bill and you bought something on a promotional balance. So for example, normally your credit card interest rate is 18%, but they offered you a promotional period of only 5%. And let's just say when it was 5%, you bought $500 worth of stuff, and at 18%, you bought $1,000 worth of stuff. and you send them a payment for $100. Where are they going to apply that $100? Most credit card companies are going to apply it against that line item right there because they want to keep you paying at 18% as long as they possibly can. And somewhere in all of the fine print in your billing agreement and other things, it's going to tell you how they allocate payments. We've got to account for that in the process here. At the organization that I worked at, the room where people processed payments was roughly the size of this room right here, but it was very, very different. The whole room was essentially a safe. It had metal walls. Everything was fireproof. In order to get into the room, there was a hallway about 8 feet long that was what's commonly called a man trap. And in order to get into that room, to get through the first door, you had to key in a pin, wave your ID in front of a reader, and then there was also a camera there that someone could look and see what was going on, and then you would make it through the first door. So you'd make it through the first door, and the hallway was long enough so that that door would have to close behind you, and then you'd go to the second door, and the second door was pretty much the same thing. But if you were the first one there in the morning, if you've ever gone to a bank and seen like a safe deposit box vault door that's like, you know, a door that's like 8 inches of solid steel with what looks like a ship's wheel on it and other things like that for keying in a keypad, that was the whole door. And the first person there had to open that, and then inside of that was a normal door like the first door that I described. And so once you did that, you could get through the second door, and you were actually into the room that they process payments. In that room, there were about 8 desks. Every corner of the room had a camera that shot into the room. Over every desk, there was a camera that shot straight down onto the desk. The employees that worked there, most of them were female, but not all, but they could not bring in pocketbooks, purses, bags, or other things of that sort. There was a room where they could leave that, like, almost like a locker room kind of thing, but nicer than that. So there was no, the idea was if anything ever was missing, you could go back and look at video to see if you could see somebody slipping something into a pocket or other things like that. And the people worked in that room, and every day the mailman would bring in huge sacks of envelopes in it, and they would run those through a machine to cut the envelopes open so that they didn't have to do that with their fingers. And then when they opened anything, they had a device on their desk where they could call up the customer account, and then once they called up the customer account, they ran the check most of the time through that, and it would print on the back of the check a number that indicated, its tracking number. It was just a sequential number that counted down the account that the credit was given to and other things like that. That would be printed right on the back of the check. And then those things at that time would have been consolidated and set off to a bank, but now with Check 21, you can actually process that against the customer's bank account instantaneously without even sending the actual paper itself to the bank. For most organizations that are sizable, this process of receiving payments from customers and allocating it on accounts and such is something that you don't just put anybody doing, and you're very, very careful about what actually happens here. I always used to be amazed. A lot of what this company did was selling. They sold to businesses, but they also sold to individual consumers. There were people that would mail in cash in an envelope, and that was just like asking for trouble, but people would do it. Don't ever do that. If you owe a bill, send a check or something, but not cash. Cash is like not traceable at all. Well, one of the reasons why I had to be so careful about this is every once in a while, customer would call you up and say, "Hey, what's the deal? I just got a bill that said I'm late in paying you, and I sent you a check last month, and you cashed the check." And you'd be like, "Wow, I'm sorry. let me investigate. And you could go back into the system and find the misposted check. And this gave you the ability very easily to go back and find that and then reverse the errant transaction from the customer who was really happy that his or her bill got paid, take that payment off and put it where it was supposed to go. So although you might think, well, it's not a big deal, we get a check, we post the payment, in reality, this is another one of those things that companies want to make sure that they do properly. So there's a payment document that memorializes every payment. Pretty straightforward what's going to be on this document. It's going to be the customer account. There's going to be a company code there because, once again, financial accounting implications. And then there's going to be dates and a payment amount. Okay? This is not at all a complicated document, but of course it's a document that we like very much and would like to see as many of these as we can in our organization because this represents the cash register ringing and money coming in the door. So, financial accounting implication, what's that? Well, this is now step 3. We just got a check from the customer for $86,700 that we're putting in our bank account. So we debit the bank account, $86,700, representing an increase in the value of an asset, and then we credit the customer account. Now you'll notice from this that if the customer owed us $86,700, only sent us a check though for $50,000, we still do the same thing. We still debit our bank account $50,000, and then we credit their account $50,000, which wipes out $50,000 of accounts receivable. What happens if a customer sends us a lesser amount, but legitimately? We quoted them of terms 210 net 30, and they paid within 10 days. So they're due a 2% discount. So how do we handle that? Well, in this scenario now, they sent us a check for $85,883. So that's what we're putting in our bank account. So we debit our bank account for that amount, but we can't credit their account for $85,833 because if we did that, we'd be reflecting that they still owe us money, and they don't. They sent us $85,833 in settlement of a debt of $86,700. So our credit is for that full amount, but then we've got that $867 discrepancy. Well, that gets posted to a sales discount account. So you'll notice if we add together the two debits here, it's reflective of the amount of the credit. Our debits and credits always have to equal, but we can't ever debit the bank account for more than the money we actually received. So we've got to show that difference. So that's what's happening here. Once again, this is another area where we have to take care in this. Notice we're wiping out an obligation here through the use of this sales discount. Well, what you wouldn't want happening is you wouldn't want someone who's working in your payment processing room to have a cousin who happens to be a customer of ours, and the customer sends us a payment for $40,000 on an $86,700 obligation, and so they debit the bank account for $40,000 and then debit sales discounts for $46,700. That's not going to work. So the computer is going to have to check and assist with this. Now, what happens if we quoted terms of 210 net 30, which meant that the customer was due a 10% discount if they paid in 10 days, but they paid us within 12 days? How hard-nosed are we going to be about that? This is one of those things where, legally speaking, of course, we could say, nope, you didn't make it in time, you owe us the full amount. And sometimes we'll do this. If a customer makes a habit of doing this, then we're probably going to have to call them on it and say, hey, look, 210 net 30 means 210 net 30. But if this is a customer who always pays us on time and always takes advantage of the discount, and one time their check comes in late, maybe even because of some kind of unusual circumstance, we're probably still going to give them the 2% discount in that situation. Walmart is somewhat famous as an organization for buying things on terms like 210 net 30, and then 30 days comes and goes, and they haven't paid, and you call them up and say, hey, you owe us $1.2 million for that order you placed, and they say, yeah, we're working on it. And you say, oh, okay, could you work real fast and get us that money because we'd really like it? But you don't want to tick them off because that's like the biggest sale you made the whole year. So now we get to 60 days and still no money. And Walmart, you call them up and say, where's my money? And they say, yeah, you know, we're not super happy with the product, but you know, we'll pay you, but we need a little bit more time. And so at the 90-day mark, a check rolls in for $1.12 million. And you're like, what's the deal? And you contact them and they say, oh yeah, well, we took the cash discount plus the product didn't sell that well, and so we discounted a little bit. And at that point, you have two choices. You can be hard-nosed about this and say, hey, you owe me some money, or you can say, thank you, Walmart, for buying from me. Please buy from me again, and you let them get away with this. And there have been some really, really interesting articles written in the business press over the years about how Walmart has essentially run some companies out of business because they kind of get them over a barrel and force them to do things they might not want to do. And then when it comes to paying, they sometimes will play games like this. Which none of this is to say that Walmart is an evil organization, but there are people that think that Walmart is an evil organization and will cite things like this as an example of that. So, you know, we've got to be careful as far as how we handle these things from a strategic perspective. Questions about this? What we've talked about here so far. All right, so we talked about customer pays us on time, full amount they owe us. Customer pays us on time with a legitimate discount. Well, let's just kind of walk through a flow chart that's in your book that describes this. We get a payment from the customer. Is it a complete payment for the full amount that they owe us? And by that we mean complete in that either it's the full amount they owe us or it's the right amount once the discount's included. Is it complete? If it is, yes. Well, okay, we're going to do a set of accounting postings that are going to clear the customer account, clear the reconciliation account, and everything is good. But what happens if they send us a payment and there's a minor difference within tolerance? So let's take cash discounts out of the picture. We just straight up sent a customer a bill for $200. And we get a check in the mail from that customer for $197. Does that happen every day? Maybe the customer is confused. Maybe the customer's a jerk. I don't know. But you billed them for this amount. They paid for this amount. So now the question is, what are you going to do about this? Well, you could say, I'm going to credit their account for the $197 they owe us, and then they're going to get a bill for another $3. Well, by the time you go to all the effort of generating the bill, by the time you drop it in the mail, by the time you process the check that comes next month, hopefully for $3, you just spent a lot more in work getting this resolved than this $3 was. So in most organizations, you're going to write off this $3. And you're going to say, okay, fine, you know, we'll put $197 in our bank account and we'll wipe this guy out and we'll say your balance is zero. And it's not at all unusual. We used to run a program in an organization I worked with before once a month that would go through, and if a customer ever had less than $5 on their account, we just wipe it off because it wasn't even worth generating a bill for. And sometimes these were companies that did thousands of dollars worth of business with us, but their payments were off by a few, maybe the customer misread it and they were supposed to send a check for $197.95 and they sent a check for $197 even. Well, you're going to send them a bill for that 95 cents? You just want this over with. So if there's a payment difference that's minor within tolerance, we're going to write that minor difference off in a manner very similar to what we did with the discounts. So we might have another account here that would be called perhaps something different, customer payment difference or something like that. And we would use it in a manner very similar to what we did here to account for wiping out that discrepancy. But the more interesting case is, suppose the customer sent us a payment that was not a payment in full. There are two different ways we could handle this. Customer owes us $1,000. They send us a check for $750. Well, we're not going to write off that $250. They still owe us that. How do we handle this? We have two choices. Choice number one is what you would probably think we would do. We would credit the customer for the partial payment, and that would leave a balance still on their account. So in this case, we would debit our bank account $750. We would credit the customer account for $750, leaving that $250 balance still on there. And that is a perfectly legitimate way for us to do this. But some organizations, based on the way they elect to do their accounting, they will do what is called posting of residuals. This is something that can be complicated depending upon all the different ways we do this, but in this instance, it's pretty straightforward. In this instance, let's say that we billed the customer $1,000 on June 1st, and they paid us $750 on June 6th. What we would do is we would credit their account for the full amount. We would credit their account for $1,000, and then we would debit it back $250. And the whole reason why we do this is to now reflect that as of June 8th, when we did this transaction, this is now a debt as of that date. Sometimes we do this because now this amount is going to be subject to interest rates, penalties, or other things of that sort. You might say, doesn't this make what could be a fairly simple transaction more complicated? Yes. But some organizations will elect to do that, and that's what you're seeing here. When we handle this by way of residuals, and every time I say that word, I think of a professor I had in graduate school who always used to call those residuals. But it's residuals. What you're gonna do is you're gonna wipe out the initial debt and then do another posting to reflect the amount that is still owed. And so that's the scenario number 2 here. Questions? We have one last big thing to talk about, and I think we can do it here pretty quickly. We talked earlier this week, I think, about credit management. We talked a little bit about it last week. Well, how do we incorporate credit management into what we just talked about? I guess before I do that, does anybody have any questions about the residual process here? Okay. So, yeah. Mm-hmm.
What if you didn't create the vendor account? Does it still have a GL account?
Yeah, we have to have, well, we have to have a vendor account here. If we sell to somebody on credit, they have to have an account with us.
You don't have a clearing account?
No clearing account. No, clearing account we would use when we buy stuff. But when we're selling stuff, we got to keep track of who owes it to us. Now, if they paid us cash, we wouldn't have any of this, but we just go directly to the cash account then.
And you only get the payment terms if you pay in full, correct?
If you pay meeting the conditions. Yep. So, we talked about we give the customer a line of credit. When do we actually check the line of credit? And what's interesting here is there are typically 3 places that we will check a customer's credit. We check when we first take in the sales order. So a customer calls up and says, I would like to place an order. And when we key that into the system will check to make sure that they're within their credit line. They have a $20,000 line of credit with us. They want to place a $15,000 order. Life is good. Take the sales order. But then we will also check their credit when we create the delivery. This is kind of covering ourselves because we could have actually had multiple sales orders come in from the same customer, and one came in by way of a salesperson and one came in by way of them using our website. And because maybe they all came in very close at a period of time, at that time, the customer was under their credit limit. But once the sales orders all went into the system, now we see that the customer's over their credit limit. So before we actually ship the stuff out, before we create the delivery, so now the key here is creating the delivery. This means but before we pick and pack, before we start gathering up the stuff, we're going to do a double check and make sure that they're still good as far as their credit limit. And then the last thing is before we actually formally issue them the goods. So the idea here is we're just going to make sure that we're managing the customer's credit appropriately, because there are some customers, and it happens all the time in business. There are some companies that do not operate ethically, and they know they're going to go out of business, and they buy stuff anyhow knowing they're about to declare bankruptcy. It's illegal to do that, but that doesn't mean that it doesn't happen. By the way, as an aside, that's one of the ways that organized crime happens. Organized crime will get an owner of a business owing some kind of obligation, and they will do what's called busting out that business, which means that they get the owner of that business to order a whole bunch of stuff from a whole bunch of different places, which they then take and fence, and then the business goes bankrupt, wiping out all that obligation. Companies have to protect themselves from one of their customers doing that. So this is why, we check, hey, we've already shipped out stuff to this customer that they haven't paid us for. And so we'll look at this, and we'll look at, okay, here's the orders that we haven't processed, here's the deliverables, and there will be times that we will see that the customer is about to go past their credit limit. But it's for a small amount. It's a good customer. We've never had problems before, so the system will generate a warning. Now, warnings are the kinds of things that people can elect to overlook. So the salesperson might get a warning that says, warning, this customer is about to go over their credit limit by $200. A human being will look at it and say, that's okay, it's within an acceptable level, continue and go on. But if the discrepancy is too big based on our configuration rules, the human being won't have a choice. The system will just say, no, that ain't going out. They owe us $10,000, their credit limit's only $15,000, they're past due $10,000 and they want us to send them another $25,000 worth of stuff. No way. We're going to block the delivery of that stuff. The fact is, the time when you have your customers most over the barrel and can insist on them paying is when they want to buy more stuff from you. I'll never forget, this is kind of one of those funny scenarios I remember. There was a restaurant that my wife and I used to love to go to when we lived in Florida, and we didn't know that they were having financial problems. And one night we went in, and my wife wanted to order for dessert bananas Foster. I don't know if you know much about Bananas Foster, but two of the key ingredients are bananas and vanilla ice cream. Her Bananas Foster arrived with chocolate ice cream, which was very bizarre. And they said, oh, we're out of vanilla ice cream. Well, first of all, Bananas Foster chocolate ice cream doesn't work, but nonetheless, we just thought that was really odd. Well, then a week later, we saw in the newspaper that such and such a company went out of business, owing their vendors like $250,000. And we understood exactly what happened. Yeah, they didn't have vanilla ice cream because nobody would sell them vanilla ice cream, but they still happened to have some chocolate that they could use for the sake of fulfilling my wife's dessert order. So the time when you most have your customers over a barrel is when they're saying, oh, I really need that stuff. And you can say, well, we really, really need your money. If you'll send it to us, we'll send you your stuff. And so this gives us a way to protect ourselves in that situation. We will stop here for today. Have a great rest of the day.